Hey guys, how you doing? Robert here. I was asked to respond to these clips that we're about to go over and validate or give my opinion on the advice given to those of you that are watching these videos as it pertains to refinancing. We're going to see if these folks know what they're talking about or if you should stay clear of this advice. Let's get into it.
That needs to refinance or is looking to refinance soon because of all the news of hearing the rates are going to drop. I am sure you are getting a lot of mail or advertisement from your current servicer or from other lending companies stating that they can help you lower your monthly mortgage payment and help you refinance. Here's a few things that you need to be aware of when you're looking at what they're advertising to you. So first thing is that if they are advertising a monthly mortgage payment, saying that they can lower it by this, saying they can lower your payment to this, 100% of the time, it is only the principal and interest. It is not including your property taxes, homeowners insurance, and then monthly mortgage insurance if you have that, because there's no way of them knowing how much you pay for your homeowners insurance, and then they don't want to look up everybody's property taxes, so they would have no idea.
So Ashley, or Home Loans by Ashley, that's the channel. She's starting off great. She's cooking, if you ask me. She's most definitely right. These mass mailing type marketing companies are only figuring out what the principal and interest payment would be, or the benefit, the reduction based upon the principal and interest. But if you've been watching my channel or this young lady's channel, she's obviously educating you on principal, interest, tax, and insurance is your total monthly payment. So don't get hoodwinked or bamboozled when you see an advertisement and it looks like the payment is just going to be super low from what you're paying, because as she's saying, they're not taking into account your escrow account. And most of these larger lenders, they're not going to give you the service of factoring in the taxes, the insurance, your new insurance, so on and so forth, to give you a more accurate picture. She's spot on so far. Let's move forward.
Second thing is, if they are advertising an interest rate, then they are buying down that rate. And by how much, it usually depends on the company. So that it could be 2% that they are buying it down.
I don't know if I necessarily agree with her 100% on this last point, as far as the advertisement or the lenders that are advertising to you are buying points, or you're having to buy points to buy the rate down. Now, that is a common practice. And the reason I say I don't agree with her is because I look at myself. My compensation plan is one in that I'm passing on a lot of the savings, the benefits to my clients initially. A lot of these larger companies, and even some larger or regional lenders, you have to understand, the more employees, the more CEOs and, core employees that they have, or advertisings that they're doing. If you're seeing them everywhere, well, those costs have to get paid for, and they're going to get passed to you. So what I'll say is this: when you get one of those advertisements, and if you move forward with a lender, make sure when you look at that loan estimate, that first box, section A, those discount points, because I do agree with her in this standpoint. That's a common practice, because a lot of you guys don't understand that depending on the compensation plan, how much they're going to make, how much I'm going to make as a loan officer per each loan, that varies company. Sometimes within companies that have different branches, that varies. That's why it's very important for you to shop. So it's kind of like, I'm not saying she's wrong, but you guys get what I'm saying. Just shop and look for the discount points. If you see them, like she's saying, then you need to get a comparison to see if you can't beat that cost as far as the discount points are concerned. Let's move forward.
The third thing is if they are advertising no closing costs. So how that works is, what they are doing is they are upping your loan amount to cover your closing costs, because you're always, no matter what type of loan you have, you are going to have closing costs. You're going to have your interest rate fee, and then your lender fee, and then any other lender fees, title fees, and then resetting up your escrow accounts. And when you're refinancing, the bulk of your closing costs are resetting up, or even a purchase, are resetting up your escrow fees. 95% of the time when I help people refinance, I as well up the loan amount. I give them the option if they want to bring funds to close or if they would rather have it included in their loan amount. And majority of the time they do, but we make sure that it makes sense. So we're not buying down the rate by a whole bunch. We do the math to make sure it makes sense.
So overall, I'll say she's doing an excellent job, very transparent, a great communicator. So I know anyone that's dealing with her, you're going to understand what you're doing. But to the last point that she made, as far as every lender increasing the loan amount, that's something I don't do. And a lot of my clients, I don't refinance them because I'm able to show them the benefit or the lack thereof when you're just looking for a couple of dollars lower in a monthly payment. I choose to help those folks find those savings elsewhere, because if you don't have the money, as she stated, to reestablish your escrow account initially, because what happens is when you reestablish the escrow account to build the new loan amount, depending on when the taxes and the insurance are going to be due with the current loan, you're going to get a refund. Okay. And a lot of times what happens is if you don't have those monies up front to establish the new escrow account, to keep the loan amount as low as possible, when that refund comes, it disappears as well. So then you get on this death loop, if you will, of constantly keeping either the term or your loan balance higher. So hopefully that makes sense. Now, if my clients persist, then yeah, we do that. But I strongly advise them when that refund check comes back, make that payment. Sometimes it's thousands of dollars. Make that a principal payment to the new loan that you have, so that we're always on the right side of refinancing.
Refinancing someone who is 5 years into their mortgage back into a 30-year mortgage is one of the biggest scams in finance. The reason this is a ripoff is because at the beginning of the mortgage term, the majority of your payment goes to interest. And then as you get further along, more goes to principal. So if you refinance back to a 30-year term, you're essentially hitting the reset button. You go back to square one where 80% of your monthly payment goes towards interest again. What you want to do instead is ask for a 25-year loan or a 20-year loan. This will save you a ridiculous amount of interest compared to starting over with a new 30-year. Payment might be a little higher, but you own your home free and clear 5 to 10 years sooner.
So Melissa is correct. That's what I was alluding to earlier. When you refinance, the key is this: going to the next 5, if you will, if you're looking at 5-year intervals. So if you did a 30-year, you've been in for 3, you want to go down to a 25-year term. And so if the numbers don't look right in that 25 years, then maybe you shouldn't do it. The only time that I would go back to a 30-year is if you, within the first 2 years, and say you bought in the last couple of years and you were in a 7.5%, and now you can get a smoking deal depending on the cost of the loan. You got to look at that. But let's say you're 5.5 to 6%, and you're still saving yourself money with the full amortized payment, the principal, interest, tax, and insurance. Well, that might make sense. What you want to do in that case is you want to take whatever the savings are, divide them into what the total cost of you doing the loan, not reestablishing your escrow account, although you might have to bring those monies up front, like they said, or worst case, add it to your loan amount. But when you get the refund, make sure you put it back towards the principal. I digress. But when you divide that savings into the total cost, that is equivalent to the number of months you have to keep the home loan for it to make sense. So if that makes sense to you, then move forward. The key is this: you have to run your numbers. And a lot of folks have jumped out the window whenever they hear stuff. They've been waiting on Jerome Powell to lower the Fed funds rate. But the question is, does that really affect mortgage rates? Well, I think we'll answer that question here a little bit later in the video. But Melissa's correct. Always lower the term. And then when you go to a lower term, if it doesn't make sense, that might be a sign of a bigger problem, because you adding on to that mortgage, you're just keeping yourself in debt. The name of the game, guys, is get on the property ladder and pay a house off, one that you're going to live in sooner rather than later, 15 years if you can. And so all of this refinancing, adding on, refinancing, adding on, that's not what we want to do, in my opinion. So if that resonates with you, cool. If not, let me know down in the comment section what your thoughts are. But good job, Melissa. You know, it makes me feel good that there's some professionals out here that aren't car salesmen. So shout out to you both. Let's continue.
The amount of people that have hit me up because the Fed cut rates, newsflash, once again, that is not a mortgage rate that they are cutting. That is the Fed fund rate for consumer loans. Listen to me. That's why I post these videos. Listen, this is what I do every day. Rates actually went up yesterday. So next time I'm telling you to hit me up to refinance, do it.
I like Larry Birdie. Or is it Larry Birdie? I don't know. She's right. The Fed funds rate deals with car loans, credit cards, student loans, new ones that are going to be put in place, HELOCs, things of that nature. They have nothing to do directly with mortgage rates. If you want to get a canary in the coal mine type view of what mortgage rates might do, check out this chart right here. The 10-year Treasury note is a great example for you to keep abreast of and get a feel as to what mortgage rates will do in the future. There's a lot of other factors, but that's just a 10,000 foot view. And anytime it's trading under 4%, then rates are going to be doing better. One other thing that you could do is just track the economy as a whole. When the economy is doing bad, in the past, it hadn't really done so much so here recently, but the concept is this. When the stock market and the economic production and growth of the country is bad, people look for safety. And so bonds, notes, mortgage-backed securities, or debt that the government is going to insure is one of those safe places that people go into. So again, not to get too nerdy, just watch the 10-year. And if it's under 4%, that is a good indicator of rate should be going down. But what Jerome Powell, the Fed chair, did, she's right, had no effect. In fact, as she stated, interest rates actually went up for the next 2-3 days after that, after we had a pretty significant run. I had rates in the 5% range, low fives, with paying 1 point for a considerable amount of time. Tap into the lender that you know, like, and trust, and let them do that work for you if you're looking to buy or refinance. Good job, Larry Birdie. Appreciate you. Let's move forward.
Okay, guys, so let's have a session about homeownership, because this is something we all need to know. So I have a client. She's been in her house for 13 years. She did a modification on her home, and she recently did a refinance on her home. A year later, she went to the bank, and when she went to the bank to try to see how much equity she had in her home, she had none. You know why? Because they're not going to tell you that when you refinance or you do a modification that you started your loan all over again. The banks won't tell you that. But actually what you're doing when you refinance, you start your loan process all over again. Now, not to mention the first, like if you're on a 30-year loan, the first probably at least 15 years, you're going to be paying nothing but interest, mostly interest toward that loan, right? So listen, you hadn't even started paying in the interest. After 12, 13 years, you only paid interest. Principal. You only paid interest, right? So basically, all she was paying was interest. So you just gave the bank 13 years of money, worth of money, and now you're going to turn around and refinance and give them some more, because it's going to restart your clock, okay? So guys, listen. If you're going to refinance, do your refinancing in the first to the third year. It doesn't even matter if they're going to give you less, if they're going to reduce your rate if you've been in that house for 10 or 15 years, because you are just giving away money. Seriously. The only way I would refinance after I've been in that loan for over 10 years is if I was in a balloon payment or an adjustable rate mortgage. That's the only way. But just a fixed mortgage, I'm not refinancing. Because if you do, you will lose the equity in your home. And when you go to try to borrow against that house or get a loan or a credit line, you can't do it because you don't have it. It's not there anymore.
Miss Chantel, that's not right. And I'm going to tread lightly because whenever I'm reacting to videos that have black folks in it like myself, a lot of y'all get upset. Where the white folks? Where the orange folks? Send them to me and I'll react to them. These are the people that are coming up in my algorithm. I digress. What I do agree with, let me start with what I agree with, Chantel. Adjustable rate mortgages, balloon payments. Obviously, when you go into those types of things, hopefully you had a strategy for why you went into a balloon or adjustable rate mortgage. Hopefully you sold before that time because that's why you would do one of those types of things. So I agree. If you could refinance into a fixed position, but still, even in that scenario, regardless of how long you've been in the loan, 13 years, in fact, if I've been in 13 years, when I refinance, I'm looking to take the new loan to only 10 years, right? 120 months. And so that's what we were alluding to earlier in the video. Now, to this client of yours, first of all, a loan modification, and I'm going to put the definition up here so you guys can read it, and I don't have to get all these text messages. But a loan modification is for someone who is in a financial hardship. And so if someone was in a financial hardship, and the way those modifications work, the lender works with the homeowner to take a payment that is comfortable for them. The rest of the payment that's based upon the loan amount goes to the back of the loan. And so when the refinance was done, that's where the equity went. The bank didn't steal it. Your client had a balance. I run into folks all the time that forget. I don't know how you forget you had a modification when you're selling a home or refinancing, and you might have 30, 40 grand sitting on the back in a second. Don't be afraid of refinancing. Understand what it is that you're doing. All of this I didn't know stuff. We got to stop that because there's a ton of documents. Dodd-Frank. If you see the documents that you have to sign, and if you're signing stuff in 2025 and you're not reading it, that's on us. But the loan modification package tells you what's going to happen. A lot of us like to play country dumb for whatever reason, but let's not demonize refinancing. Also, on the other side, say the Fed lowered rates and everybody should refinance. That's not the case. We all have to look at things on a case-by-case basis. Refinance, lower your term when if all possible. If you're refinancing, trying to hold on to something that you can't afford, maybe that's a different conversation that you have. You see what I'm saying? So you can live to fight again because you just digging the hole deeper and you're not really fixing or getting to the root of the problem. Shout out to everybody that I reviewed. Good job. Continue the good work. For those of you that might be looking to get on the housing ladder or refinance, let's stick with the theme. If you're looking to refinance, say you're already on the housing ladder and you want to have a consultation, my contact information is pinned in the description for sure, but it might be in the pinned comment below. Either way, reach out. First 15 minutes is free. It's on me. Let's discuss to see if we can move forward. So my time is up. I thank you for yours. As I always say, guys, let's be good to one another. Let us let grace abound. And before you get out of here, watch this video right here. And till the next time, indeed, y'all stay blessed.